everyone, you're watching The Money Show right here on ET Now, India's only show where we talk about personal finance, get in viewer questions and queries live right here on the show and get it answered by our financial expert. I'm Mubina Kapasi, and first up, let's introduce then our expert who's going to be joining us on this show, Pankaj Mathpal, the MD of Optima Money Managers. I'd like to introduce him. Pankaj, thanks so much for joining in on ET Now's The Money Show. Ladies and gentlemen, today's topic of discussion, among many others, is going to be mutual funds and FMPs in particular, given the kind of scare it has sent down the spine of a lot of investors last week. Now, the question, of course, is how should you pick out a mutual fund? How much of importance should you give to the underlying, to the asset manager, and of course to the credit rating as well of various underlying assets that a mutual fund invests in? And how do you read through all of that financial jargon? That's the key question to ask. So Pankaj, help our viewers navigate the entire mutual fund spectrum, and how best could they avoid, or perhaps not completely avoid, but mitigate such instances as what happened with Kotak's FMP last week.
See, mutual fund is an investment vehicle that invests in some shares and securities. Now, when you invest in equity schemes, the underlying assets will be equity shares, but when you invest in debt funds, the underlying asset will be some government securities like treasury bill or bonds, debentures, commercial paper, certificate of deposits. This kind of securities will be underlying of that scheme. Now, most important in the debt is the credit risk, because the quality of those papers, that is important. Sometimes what happens, in expectation of high returns, investor invest in some scheme where the quality of security is poor. See, most important is that return of money, then return on money. So most of the time when investor invest, they see the past historical returns, and where the returns have been higher, investor they go with that. But investor has to see where the returns have come from. If the quality of paper is good and then also you are expecting you are getting good returns, then definitely that's a good scheme. But if the underlying securities have the poor quality papers, then definitely one should avoid it. So one should go with the FMPs or debt paper where the underlying bonds, debentures, these are either the sovereign bonds, means government guaranteed bonds are there, or otherwise if these are the private debentures or corporate debentures, it should be AAA rated, AA plus rated, something like that. So always see the quality of those papers, that is important. When we invest in debt funds, usually FMPs are considered to be better compared to open-ended, because your underlying asset has the maturity similar to the maturity of that scheme. So interest rate risk is mitigated, but still credit risk is available there. So investor, when they invest in fixed maturity plan, they must see this, that what kind of, though portfolio will not be disclosed before investment, because these FMPs are available for investment only during NFOs, new fund offer, and once you invest you cannot exit means till its maturity. Only in secondary market you can trade, but you have to see that what kind of papers are there, you should ask, and the FMPs which are coming with the good quality papers, in those scheme only you should invest. So one should not become very greedy unnecessary, otherwise you may not get your money. What has happened with the Kotak right now, it may happen in future also with many other schemes if the underlying securities are not good quality. So you have to see that you have to invest in a good quality schemes where underlying assets are AAA, AA plus, something like that.
FMPs are almost like FDs, Pankaj, correct me if I'm wrong, of course. You have to like sell, you get your money back at a fixed maturity, but yeah, you don't want to be in a situation, or at best you should try and avoid a situation like that where money is delayed. So it's important to see the kind of underlying assets that these fund managers are investing in. Okay, well, ladies and gentlemen, this show, like we say, is all about your personal finance. So all the questions and queries you have with respect to investments, mutual funds, for individual stocks, we'll take it up on buy now, sell now. But yeah, for mutual funds, for wealth creation ideas, for SIPs, this is the show where we have with us Pankaj Mathpal, and he's going to be answering all the questions and queries. For now, let's go across to the first question. It's a very long one, I must say. It's coming in from Indru Bhavnani. She's a senior citizen. She says she's 80 years old and has investments both in the secondary market as well as via mutual funds. She has a PPF as well, which will be around worth 20 lakh rupees, and she has sufficient funds for the next few years in case of an emergency. So both in FDs and MFs about 10 lakhs and FMPs 20 lakhs, and she will not be requiring this money hopefully for the next 3 years. Now she's looking to invest in open-ended short-term debt funds or overnight funds to preserve her capital and earn about 8 to 9% instead of FDs, and later go in for SWP for tax efficiency. Now she's also looking for liquid funds. So she essentially wants to know some names, some mutual fund names. She's a little wary, of course, investing in more FMPs after the entire ILNFS and then DHFL and Z and SL group fiasco that has been caused. And also, of course, so that's one part of the question on certain short-term debt funds or liquid funds where she wants to essentially earn a higher interest rate. The second part of the question is the tax implications going in for the daily dividend option, because it's difficult to keep track of that, and also she wants to know if she can opt for a monthly or a quarterly dividend reinvestment scheme, because according to her, daily dividend is a headache. So it's a two-part question. Pankaj, let's get in your recommendation on both.
See, first thing, if you want to invest for 3 years, then I think that liquid fund or overnight funds or the short duration funds, what you are talking about, is not the right choice. Usually, for the contingency or to park money for very short duration, then you invest in such schemes. And as you have mentioned that you want to invest for 3 years and you do not need liquidity, you have sufficient money for to manage your cash flow. So my suggestion that instead of this kind of schemes, you should go for some equity saving schemes. Equity saving schemes are where they invest in arbitrage, debt instruments, as well as a small part goes in equity. So equity saving scheme can be a good choice, or considering that 3 years time is there, because you have to create some good returns also. Though you said that 8 to 9% return you are expecting, is not the right expectation from these overnight funds, that 8 to 9% from liquid funds. From liquid fund, we expect something like 6%, 7%. So 8, 9% you cannot expect from these kind of schemes. So better you go for equity saving funds like ICICI Prudential Equity Saving or Kotak Equity Saving Fund can be good choice. Or even if you can take little bit more risk, because you have 3 years time horizon. So there are balance advantage fund like ICICI Prudential Balance Advantage or Aditya Birla Sun Life Balance Advantage. These balance advantage fund where the equity allocation can go up to 100% even if the market is good, or it can come to zero also. So this kind of funds where fund manager decides that how much allocation should be in equity, how much should be in debt. So that kind of scheme also you can consider in your portfolio. But if you want to reduce the risk, then as I said, equity saving funds can be a good choice for you. But still, if you want to invest only in overnight funds or short duration fund, so you can go for Aditya Birla Sun Life short duration, short term funds, or Franklin India short term income fund. So these can be choices, but then don't expect 9% return from these overnight funds or liquid funds.
All right. So those are some fund recommendations coming in from Pankaj. And yeah, like he said, if you're not in urgent requirement of money, it makes sense to put it in an equity savings scheme, which, is Pankaj's recommendation. Okay, moving on to the next question. I think it's a phono. Yeah, we have Sanket from Mumbai joining in live on the phone line. Hi, Sanket. Good evening. What's your question for Pankaj?
Hi, good evening, Mubina, and thanks for taking my call. My question is, we have newborns in our family, looking to accumulate a corpus for their higher education. The time frame we're looking for is about 10 or 15 years from now.
Mm-hmm.
We intend to invest about 15,000 per month. And with each passing year, we intend to increase our contribution by at least 10 to 15%. So if you could suggest some funds for the long run, we would appreciate that.
Sanket, you have two children, is that right?
Yes.
Two children. Okay, all right. Pankaj, two children, 15,000 per month, an increase of 10 to 15% annually. So my first question is, do you think this amount would be sufficient if we are talking about higher education, assuming the highest level, that's going abroad and assuming even a PhD for that matter, and that's going to be, the expense is expected only 10 to 15 years from now. So with an annual increment of 10 to 15%, 15,000 per month, do you believe this amount is sufficient? And also if you could recommend some suitable schemes.
See, first thing, because initially when we plan, we never know that how much money will be required, but based on that today's cost of that education, we can think something. So like he has sufficient time, 15 years as you said, and you have also mentioned that you can increase your investment by 10-12% every year. So it's a good planning. But only thing, because we have to beat inflation, we have to create wealth. So equity has potential to deliver good returns in long term. My suggestion, initially you should start only with equity schemes. So if you want to invest 15,000 rupees, 4 to 5 schemes, well diversified, like one large cap fund, one multi cap fund, one mid cap fund, and considering that you have 15-year time horizon, one small cap fund also you can include in your portfolio. So suggestions like ICICI Prudential Blue Chip Fund is a good large cap fund. Mid cap, you can have Kotak Emerging Equity or L&T Mid Cap Fund. In multi cap, you can go with the Aditya Birla Sun Life Equity Fund or Kotak Standard Multi Cap Fund or ICICI Prudential Multi Cap Fund. These are good multi cap. And small cap, I'll suggest you SBI Small Cap Fund. So one large cap, one mid cap, one multi cap, and one small cap. That should be your allocation. So I have suggested you schemes. And yes, maintain discipline, increase your investment time to time. Do not see the performance on daily basis, but yes, once in the 6 months you should review your portfolio. If the scheme is not performing as the benchmark or as compared to its peer group, then you should think about changing the scheme. Otherwise, stick to these schemes for long term.
All right. Yeah, discipline and also checking in on your portfolio is important. And of course, we at ET Now are always here. The Money Show will be here to get your portfolio reviewed as well, now and then. But of course, no need to keep a hawk eye on it as such. Sanket, good luck, and I hope you're able to meet your financial goals comfortably. Let's move on to the next question. We have Sachin Gupta on the phone line. Hi, Sachin. Tell us, what's your query for Pankaj? Good evening.
Good evening. I would like to invest lump sum in mutual fund, and basically in the large cap, multi cap kind of fund. Since I already have invested in a small cap fund, so I would like to know which are the good funds in which I can invest for a long run, and also would like to understand how if I invest through liquid fund, then how the taxation part is calculated on liquid funds if I transfer it through STP.
Okay, all right. So Pankaj, if you could recommend some, he already does have an investment in a mid cap fund, if I'm not mistaken, or a small cap fund. Now he wants to look at investing a lump sum in a large cap fund. So what would you recommend, and also the tax implication for a liquid or a debt fund?
See, as first you said that you want to invest in lump sum, my suggestion, do not invest in lump sum considering the market volatility. Invest in staggered manner, and STP is the good choice. In STP, you invest the lump sum amount in liquid fund, and from liquid fund you transfer, that you mentioned as such. So scheme I'm suggesting you, like you said, long term. So ICICI Prudential Blue Chip is a good large cap fund. Invest in this. In one multi cap fund, you can have like ICICI Prudential Multi Cap or Aditya Birla Sun Life Equity Fund. One mid cap, again you can go for in mid cap Kotak Emerging Equity Fund or L&T Mid Cap Fund, and small cap already you have, so do not add any small cap. Now once you decide to invest in these schemes, you have to invest in the liquid fund of the same fund house. Like if you want to invest in ICICI Prudential Blue Chip Fund, So first you have to park money in ICICI Prudential Liquid Fund, and you have to set that every week or every month how much money you want to transfer from liquid fund to equity fund. For example, if you want to invest 10,000 rupees per month, so first from liquid fund you'll park the money, and from there every month or on the weekly basis, whatever you decide, my suggestion will be you go for weekly STP. So 2,500 every week. If you set, the money will keep on transferring from liquid to equity. So make this arrangement for next 4 to 6 months. So in 4 to 6 months, entire amount what you invest in liquid will get transferred to your equity schemes. So it will counter volatility. Second thing, the tax implication. What happens when you invest in liquid and from liquid you transfer to equity? It is like selling from the liquid and buying in equity schemes. So whenever you are redeeming, whenever you are switching from liquid to equity, it is your units are redeeming there. So it will be a short term capital gain, and short term capital gain on liquid schemes or any other debt scheme is basically your profit will be added to your income. So if you are into 5% tax bracket or 20% tax bracket or 30% tax bracket, see, as you may be aware that the income is less than 5 lakh, then 5%, 5 lakh to 10 lakh, 20%, and the individual who has income above 10 lakh, he or she falls in 30% tax bracket. So this profit from the liquid fund will also be added to that income, and you will pay tax as per your income tax slab.
Okay, so that's the simple explanation of how and what will be the tax implications for the debt funds or liquid funds, and also some names that Pankaj has recommended. It would ideally be better if you could make your investment by an SIP as opposed to a lump sum to sort of counter the volatility that we are seeing in equity markets, and with elections around the corner, that's only going to increase. So do take that as well into consideration. Okay, we'll take a very short break right here on the show, but our phone lines are open. So like Sachin and Sanket, you too can get your questions and queries answered by Pankaj Mathpal. Stay tuned. This is The Money Show. Welcome back. You are watching The Money Show right here on ET Now, where we are answering questions and queries on personal finance, and it's Pankaj Mathpal who is helping us out today. Let's move on to the next question. It's coming in from Mahadeep Singh Chachi. Now, Mahadeep says that he's a retiree with mutual funds constituting the largest part of his nest egg. In the absence of any specific goals, his only objective is essentially to grow this, to grow his investments. It's a hard-earned corpus earned responsibly over the last 10 years, and he does not need any income for day-to-day expenses. So he just wants to know some funds that he could invest in to essentially help his basket of mutual funds grow. Now, Pankaj, you have suggested a lot of names to our earlier callers, Sanket and to Sachin as well. But for the benefit of Mahadeep, if you could just reiterate, he's already a retiree, by the way, so his time horizon, of course, may be a little different. But if you could reiterate, what would be some suitable schemes that Mahadeep could invest in?
Yeah, because Mahadeep is a retired person in earlier questions, because they were planning for 15 year, 20 year, and they were very young. So I suggested small cap, mid cap, multi cap, everything. But here, considering the profile, though you have a good time horizon, but my suggestion that you should stick to some large cap, diversified large cap funds, and some hybrid schemes. Hybrid scheme where the investment goes in debt and equity. So do not go with the very high risk schemes where means you can expect a good returns, but at the same time your capital is at very high risk. So my suggestion that like schemes, ICICI Prudential Blue Chip Fund or Aditya Birla Sun Life Equity Fund, this kind of scheme should be in your portfolio. Or even I'll suggest that Balance Advantage Fund like ICICI Prudential Balance Advantage Fund or SBI Hybrid Equity Fund, where the investment goes in equity and debt both. So this kind of scheme should be there, because stability of portfolio is equally important for you. You do not have now new earnings, so whatever you have accumulated, that should grow with time, but at the same time risk should be minimum in such schemes.
Okay, so that's an important lesson as well for all retail investors. Not everyone's investment objectives, investment time horizon is same, and hence the recommendation that your financial advisor would give you would differ, and hence it's so important to ensure that you get correct advice and you properly consult with a financial advisor. Okay, next up we have Jay Venkat Rangam, who has sent in a question. It's on the IDFC multi-cap fund, where he has been investing via an SIP 3,000 rupees per month for the last 8 years. He's not given any other information of whether this is his only investment avenue, but he wants to know now whether he should stay put or exit. So, Pankaj, based on the performance of this fund vis-a-vis the benchmarks, vis-a-vis its peers, would you say that this is a good fund to be in? He's already been in it for the last 8 years.
See, IDFC multi-cap fund was earlier IDFC Premier Equity Fund, and it was a mid-cap fund. But last year it was restructured as a multi-cap fund. So if you see the long performance, long-term history, it is good. It has performed well, but that is not relevant because that time it was a mid-cap fund. But if you see its performance in last 1 year, 2 year is not good. So considering the current portfolio, considering the short-term historical returns of last 1-2 years and inconsistency in performance, my recommendation that you should exit from these schemes, because there are many schemes in the multi-cap category which are performing very well, like ICICI Prudential Multi-Cap, Aditya Birla Sun Life Equity Fund, Kotak Standard Multi-Cap. So there are better schemes. You exit from this scheme immediately and invest in some other schemes.
From this one, not exactly the best scheme to be in. Well, that's all the time we have for questions and queries, so we'll have to wrap it up. Pankaj, thank you for joining in and helping our viewers out. And of course, if you too want to send in a question, this is the one-stop shop where we will get to answering questions and queries with personal finance experts. It's a goodbye. Stay tuned to ET Now for news and updates.